2024 has started and we are already witnessing a huge wave of startup IPOs in India. In fact, lot of very big companies, lot of very renowned startups like Ola Electric, like Oyo Rooms, like FirstCry are planning to bring in their IPOs in the next few months of 2024. But if you go through the books of accounts of these startups that are planning to bring in their IPOs, you'll notice that majority of the startups that are planning to bring in their IPOs are actually not profitable. In fact, they are in incredible amount of losses. But if you actually go through the books of accounts of these startups who are planning to bring in their IPOs, you'll notice that majority of these startups are in incredible amount of losses and are not profitable. I was going through the fundamentals of Ola Electric, who's planning to bring in its IPO, and I noticed some very weird stuff. The reason why Ola Electric is planning to bring in its IPO is because of the fact that the company is running out of funds and is unable to raise funds from the private equity market. The company currently has somewhere around 1100 crores left in its bank, and because the currently monthly burn rate of the company is 250 crores, it only has a runway left for the next 4 to 5 months. It means that the company will run out of cash in the next 4 to 5 months, and in order to keep the business operations alive, in order to keep the company alive, it obviously will have to raise funds. And because funding winter is going on in the private equity market, the company is planning to raise funds from the public through its startup IPO. Moreover, India's history with startup IPOs has not been good. You guys must have noticed that lot of very big and renowned companies like Paytm, like Nykaa, like Zomato came with its IPO in the recent times, and the IPOs were terrible. In fact, retail investors, individuals like us who invested in the IPOs of these startups, faced incredible losses because of the fact that the companies were incredibly overvalued. So the question is startup IPO really worth of investing? Is startup IPO actually a good investment option for retail investors like us? Or are startup IPOs nothing but a big scam? This video is going to be incredibly valuable for you guys, because in this case study we are going to talk about what exactly is an IPO is, how exactly do IPOs work, what are the primary reasons why these startups bring their IPO in the first place, what is the difference between a business model of a traditional company like Reliance or Tata and the modern age tech startups of India today, and the final question that we are going to address in this case study is the same one, that are startup IPOs nothing but a big scam? We are going to analyze all of these questions in today's video. Please watch this video till the end because it has a lot of value in it. If you are planning to invest in one of the startup IPOs, please watch this video till the end, because there are going to be a lot of insights which will help you make this decision whether you should invest in one of the startup IPOs or not. Let us first start with a very simple and fundamental question. What exactly is an IPO? For those of you who do not know, IPO means initial public offer. Let me explain it to you guys with a very simple and a very practical example. Let us assume that you guys start a business today, you guys launch a startup today. Obviously, in the initial months to bring your company to life, you'll obviously need to invest some amount of capital. Now, in order to get that capital, you can either invest your own money, which we call as bootstrapping a startup without raising any external funds, or you can pitch the same idea to your friends, to your family members, etc., and ask them to put in some money in the initial phase. This money that you guys raise in the first place for your startup is basically called a seed round or a pre-seed round. This is done primarily to bring the company to life and to help your idea come into existence. Now, once your company starts achieving some certain amount of traction, some certain amount of numbers, some amount of user base, some number of consumers, and once you are in that growth stage where you have some sort of traction, obviously in order to fuel that growth, obviously in order to expand, you are going to need some additional amount of capital. Now, where to get that capital from? As a private company, you can pitch for the next round of your funds, you can pitch your idea, you can pitch your business to these angel investors, to these venture capitalists, what exactly we seen in Shark Tank India. You guys can pitch your idea to a person who has a lot of funds available. You can pitch the idea to that person, and against some part of your equity of your company, that person can give you some certain amount of funds, which we call as a series round. So venture capitalists, angel investors, high net worth individuals can invest in your startups in the growth stage and can help you fuel the growth of your startup. Now, once you have achieved a certain level of growth, once you have achieved a certain level of scale, and you are planning to expand your company, you are planning to expand your startup to a much more greater extent, obviously again you will need some amount of capital to fuel that part of growth. Now, in order to fuel that part of the growth, because it will require huge amount of funds, you can actually you guys have an option of raising the funds directly from the public. You can offer the public a part of your equity, a part of your company's equity, as you have offered to these high net worth individuals, to these venture capitalists, and to these angel investors. Similarly, you can offer some part of your company, some stake of your company to the public, and from the public you can raise a certain amount of funds. This is exactly what we call as an initial public offer, or an IPO, in which the company raises funds directly from the public. Now, the second question is, why exactly do companies raise through the public? Why exactly do companies get their IPOs in the first place? And what is the primary difference between a business model of a traditional company like Reliance or Tata, and how do exactly these tech startups work in today's modern world? In the initial times, if you study the business models of traditional big size companies like Tata and Reliance, who have had incredible IPOs in the first place, you'll notice that the primary reason of IPO was to fuel the growth of the company. You'll notice that the primary reason that these guys, these big companies, these traditional companies of India brought their IPO was because of the fact that these companies wanted to go global. These companies wanted to expand incredibly, and these companies were actually profitable in the first place. These companies have had a simple business model in their head that for every piece of product they sell, for every piece of service they sell to the customers, they have to make certain amount of margins, they have to make profits on every transaction. And once they are doing that, once they are profitable, they have good numbers, and everything in their books of accounts is transparent and good, they finally decide to get their IPOs to fuel the next part of their growth. This is how the traditional companies of India have been operating. But ladies and gentlemen, and the students of business, the modern tech IPOs have a different story altogether. The reason why modern IPOs, modern startups raise funds from the public, the reason why modern startups launch their IPOs in the first place is not because of the fact that these companies are planning to grow, but it has a different side of story altogether. Now, to understand this, let us again consider a very practical example. Let us say that you have launched a startup, and in order to fuel the growth of your company, in order to raise funds, you guys pitch your idea to me and ask me to invest 1 crore rupees in your firm, in your company, against 10% of your shares. It means that obviously I'll buy 10% of your company, I'll buy some sort of shares, some amount of shares, some number of shares of your company, and then against those shares, I'll put in 1 crore rupees in your company for your startup, right? Let us assume that I am buying your shares at rupees 100 per stock, 100 per share. Okay. So if at one point of time I want to, as an investor, if one point of time I want to make a return from my investment in your startup, obviously I will make a return once my stock price, once the price of shares that I have invested in, that is rupees 100 as of now, right? I'll make a return once the stock price, the share price grows to an extent, for example rupees 1000, and once your stock price reaches to rupees 1000, I'll sell off my 10% of the stake to someone else. It can be public or it can be another individual, and that is how, ladies and gentlemen, investors, venture capitalists, and all these angel investors make money from their startup investment. In simple terms, currently I am buying 100 rupees of your stock. I am buying a stock from you guys at rupees 100, and I'll make a return on your company. I'll make a return on my investment in your company once the stock price reaches rupees 1000. It simply means that investors will make money once the valuation of their stock, once the valuation of the company grows to a great extent. You guys have commented a lot of times on my business case studies as to why exactly these loss-making companies have such incredible valuations. Well, here is your answer. The reason why these companies are overvalued is because investors are pouring in money in these startups, and investors can make money only when the valuation of the company grows, when the stock price of the company grows. Now, in order to cash out my investments, in order to liquidate my investments, in order to get cash in my hand against the equity that I'm holding in your startup, obviously I need some sort of exit. I need an exit event, and that is exactly what an IPO is. IPO is an event wherein these investors can actually sell out their stocks to the public and can make a return out of it. In simple terms, I had invested in your company 1 crore rupees, and the stock price at that point of time, the share price at that point of time was rupees 100. Currently, after 5 years, let's say your stock price, one single stock, one single share is valued at rupees 1000, and now because you are planning to bring in your IPO and your shares are valued at rupees 1000 per share, and I had invested at rupees 100 per share, I am already making 10 times of my investment, 10 times return on my investment. And now because at this point of time, because on the day of IPO, I as an investor have an opportunity of cashing out, of liquidating my investment, this event is extremely important for me as an investor. So as an investor, it will not bother me whether your startup is loss making, it will not bother me if your company is running out of runway, it will not bother me if your company is providing good quality goods or service to the customers. The only thing that bothers to the venture capitalists, to the people who have invested in these startups, is the fact that their stock price, the valuation of the company should grow, and they should get an exit as soon as possible, and that happens on the day of IPO. Now, with the discussion that we have done till now, you guys must have understood that for traditional companies, IPO meant raising funds from the public. The companies were already making money, the companies were already profitable enough. IPO simply meant raising incredible amount of funds from the public, which will help their companies grow to a better extent. This was the primary concern of traditional companies in India. But currently, all these tech startups do not have this concern. In fact, the concern of tech companies in India, the modern tech startups of India, with the IPO event is basically the fact that they have to give their investors an amount of return on the investment that they have done in the startup, and they have to give an exit to the existing investors of the company. They do not want to raise funds from the public to fuel their growth or anything, but the only point is they want to give the investors, the venture capitalists, these high net worth individuals, an exit from their investment and giving them an incredible amount of return on their investment. Now tell me a very simple question, right? From everything that we have discussed so far in the case study, you guys must have understood what exactly is the mentality of tech startups while launching an IPO in today's world, right? Do you think is it justified? Do you think it is justified raising funds from the public in order to give an exit to your existing investors, in spite of the fact that your company is already in incredible amount of losses, your company is already not serving customers to a good extent, your company is very far from being profitable, yet you are raising funds from the public by making false promises to them for return, and you are using those funds which you have raised from the public to give a return to your existing investors of your company? Do you think it is justified? Well, all the startup IPOs that we have seen have actually done the same thing. They have launched their IPO in the first place. They have raised incredible amount of funds from the public by making false promises to them, by making false commitments to them. And once they raise incredible amounts from the public, they basically give their existing investors an exit, and again they are left with cash crunch and no money to run their business. And this is the reason why once the startup IPO in the modern tech generation, once a startup IPO comes into existence, we see that these companies in the first place were overvalued, and once the startup IPO comes into the place, the company crashes and the stock price crashes on the next day itself. And at the end, retail investors, individual investors like us who expect a return on our investment by investing in these startup IPOs actually end up losing a lot of money. Now I want you guys to tell me in the comment section, do you think that investing in the startup IPOs in today's world, when majority of the startups are not profitable, when the agenda behind the IPO is to give an exit to the existing investors by making them a good amount of return and ultimately being in losses at that point of time itself, do you think it is all worthy enough? Do you think that startup IPOs are nothing but a big scam? Please comment down below and let me know your insights and your analysis about the same. If you liked the video and found the content valuable and useful, I request you guys to please kindly hit the like button so that these case studies, these valuable insights can reach to the masses of India, and these case studies can help a lot of Indians, lot of retail investors to actually think twice while investing in a startup IPO. If you want more business case studies like this, I would request you guys to kindly hit the subscribe button and hit the bell icon as well to get regular notifications on all of our business case studies. This case study was brought to you by the B School, your online business school. I am going to see you guys in another business case study very soon. Till then, stay tuned, take care, bye bye.